A basic retirement income plan. Where you're going to draw money from in retirement and what are the consequences of that decision is possibly the single most important retirement decision you're going to be faced with as you progress on your retirement journey. Today, I'm going to walk you through the basics of where to draw money from and when so that you can minimize your tax liability and maximize the amount of money that you get to keep. First off, it's important to note that there are three types of money you're likely to have as you head into retirement, and they're all taxed differently. Isn't that fun? Additionally, beyond just how they're all taxed, all of them can trigger additional taxes like the Social Security tax torpedo or a visit from nasty Aunt Irma. That's Irma, IRMAA. It's a tax penalty on Medicare, not literally your Aunt Irma. I don't know her. She's probably a wonderful woman. Back to the three types of accounts, you've got to be taxed money, after tax money, and tax free money. First up is the to be taxed bucket. Here you have money that hasn't been taxed yet. Think 401ks, 403bs, traditional IRAs. All of this money got a tax break on the way in. It's been growing tax deferred for years, but now as you draw it out, you're going to be subject to tax. Next up is your after tax money. This is your pay as you go plan. Think about bank savings money, non-retirement brokerage accounts fit in here. You've paid some taxes on these gains as you've had them over the years while you were earning them. So this money is often very low on tax creation as you use it. That's a good thing. See, we want to do two things as we take distributions. One, we want to manage the tax liability on a year-by-year basis to avoid any major tax surprises. And two, we want to avoid being forced into large amounts of distributions. More on that in a second. Finally, the third type of money, you have your tax-free money. Generally, that's Roth money, although it could be other things like municipal bonds or cash value life insurance. These are accounts that don't trigger additional taxation when you access money from them. I've got the graphic up here on the screen lined up in the way I do because it shows you your least favorable tax money in retirement starting on the left, moving to the most favorable on the right. Coincidentally, it's the reverse order from what it was while you were working. While you were working, the to-be taxed money was great because you were earning income and it was generating tax deductions for you. Now that it's time to use some of those assets, it's the reverse order. This is a financial version of the saying, you can't have your cake and eat it too. Now, most folks I talk to who are either at retirement or nearing retirement look a little something like this. For example, if I meet someone who has, say, $2 million, 9 times out of 10, it looks similar to this. $1.6 million or so of to-be taxed or 401k traditional IRA money. $250,000 taxable, $150,000 Roth. Now that breakdown, whether you have $1 million, $2 million, $3 million, having 70+% of the money in to-be taxed is not out of the norm when you get to retirement. Now, if they follow conventional wisdom, they're going to use the after-tax money first. Somewhere along the line, they're going to elect Social Security, depending upon when exactly they retired. And then they're going to punt that to-be taxed money, that big ball of money, until either one of two things happen. They need to access it to support their income, or they are forced to access it. Forced through the major culprit, that's RMDs. More specifically, RMD creep. RMD creep is not some weirdo leering at you from the corner. It's creep as in your required minimum distribution amount is going to go higher and higher the deeper you get into retirement if you don't do something to stop it. You see your RMD amount, the percentage of your to-be taxed money that you have to take out from those accounts, it goes up each year once you hit RMDs. And if your accounts are doing well and therefore your balances are rising, now you've got to take a larger percentage of a larger pool of money. This results in ever higher distribution amounts. And remember, any money that comes out from this is subject to being taxed. So ever higher distributions means ever higher taxes. Your silent partner, Uncle Sam, he's going to wet his beak on that money every time you have to dip into it. And at some point, he's going to make you start tapping into the money. This is what I mean when I talk about RMD creep. This is a graph of a 64-year-old with $1.6 million in to-be taxed money, kind of like what we were talking about. It grows at 6% per year. They don't need to take the money, so they're waiting to RMDs. By the time their RMDs start at age 75, this is what they're looking at. That balance by 75 has grown to over $3 million. Their first RMDs, $123,000 plus dollars. By the time they get to 84, they've got RMDs of $196,000 a year. This is the problem with just deferring the taxes as long as possible on those sorts of accounts. So if you're in a similar situation, I've just explained what not to do. How do we figure out what to do? So here we go. In general, the considerations here are this. One, how much income will you need in retirement? What's the dollar amount on a monthly basis that keeps the train on the tracks? We're not talking about the fun stuff here, just how much income do you need for regular everyday living? Step 2, how much guaranteed income will you have coming in? That's Social Security, pensions, other sources like guaranteed lifetime annuities, etc. And then 3, what's the gap between those two numbers? For example, let's say that you need $8,000 a month or $96,000 a year in retirement income. And let's say that you've got $4,000 a month per month coming in guaranteed income sources, Social Security, for example. You've got to find another $4,000 in income from your investments in one form or another. Now, the name of the game here is to get that $4,000 as tax efficiently as possible while also keeping in mind that the long-term impacts of your early retirement decisions can make a big difference over your lifetime. Meaning, if you just drew all of that $4,000 per month from the post-tax account early on, you might have zero taxes due. But RMD creep is looming and waiting, and it's going to wreak havoc on your tax bill later on. So what I'm going to do here is give you a general framework, and then I'll give you 2 specific examples as we go through that framework in action. First off, if you have very large to-be taxed balances, think $1.5 million and up here in 401ks, traditional IRAs, 403bs, you've got to find a way to level your taxable income over your retirement to stay as low on the brackets as possible because you're in danger of that RMD creep. That either means using the to-be taxed money to fund your retirement income gap early on, provided that it's a manageable amount so that you can help keep future RMDs lower, or using post-tax money and then converting some of those assets to Roth money, which will lower your future required minimum distributions and shift money from the least favorable account to the most favorable account. By all means, in the example I just gave, as well as the one I'm about to give, preserve your Roth balances to last. That's the last money you want to get to because it's essentially the most powerful money you have because it's tax-free. It's all yours. And so unless you need to access it to avoid something like the Social Security tax torpedo in a given year based on where your income is projected to be, you don't want to do your day-to-day retirement income living from that tax-free bucket. So if you're 401k and traditional IRA heavy, typically you want to use some of that money early or convert some of that money early while your income is low enough to lower future tax bills. Now let's talk about the second scenario. If you're not particularly to-be taxed heavy, maybe a large portion of your portfolio is in after-tax money. You did well picking some stocks, or you got a lot of brokerage assets, and that's a large portion of your retirement portfolio. Or maybe you were very focused on Roth accumulation during your accumulation years, so a lot of your money is in that third option, the tax-free Roth money. Or maybe you just have lower general account balances as a whole. So here, if your traditional balances are, let's say, $500,000 or lower as a general rule, you're not likely to have the same RMD creep problem because RMDs typically won't be so high as to push you way up in the tax brackets later on. Now, if that's you, you have more flexibility depending upon your income needs. Here, a mix of money coming from after-tax accounts, as well as some traditional distributions early on in retirement, is typically the best route. In part, that's because the standard deduction right now for a married couple over the age of 65 is over $30,000. And so even if you aren't particularly to-be taxed heavy and you're not worried about RMD creep, if Social Security is your primary source of retirement income, it can still make sense to take some IRA distributions pre-RMD years to take full advantage of the standard deduction. I'll give you an example of what I mean. If you're a married couple and you have Social Security income of $36,000 a year, total Social Security benefits of $36,000 here in 2024, and no other taxable income, you can actually take about $25,000 out of traditional IRA accounts without incurring any federal income tax. In that case, you've gotten $61,000 of money in your pocket at a 0% federal tax rate. Zero. None. It can make a ton of sense to look at a strategy like that if that's what the portfolio looks like for you. So if that's you, if you don't have huge income needs and most of your retirement income is coming from Social Security, it can make sense to leak money out of that to-be taxed bucket while staying below the income thresholds, and you can potentially look at tax-free money coming from a to-be taxed account. If you're looking for more insight on lowering taxes in retirement, check out this guy right here.